Wow, mortgage rates have finally dropped a little bit, but overall they're holding stable. We did just see a huge number of homes get delisted from the market, and we're actually seeing the financial markets come back after having a really soft second quarter. Coinbase and Palantir are doing really well, and we did see the Nasdaq and Bitcoin hit new all-time highs. So we have had more tariff talk, but thankfully this time around, it's not moving the markets as much as we saw last time. Lots of things happening. We'll get into all of it. First, I just want to say a huge thank you to everyone for your support, for the emails and the questions that you've had after some of these videos. Glad to answer those and explain things. So please subscribe to the channel, like the video. I will do my best to bring you more information about our national and financial markets, and then also how does that relate to our local real estate market so that you can make the best decisions for your future. So let's dig into it. So this is our July update, and we're going to talk about all the real estate market data from June. Before we get into that though, let's talk about some of the higher level stories. So mortgage rates, like I said, they're continuing to hold stable. They are in the high sixes. That's a little bit better than where they were, hovering right around 7. Obviously, your rate's going to depend on your credit score and your financial situation. That's for conventional loans. If you're doing FHA or VA, those are going to be just a little bit lower, but oftentimes those will come with some type of mortgage insurance, which is going to bump the payment up a little bit. So there are benefits to both. Talk to your loan officer. So what I am seeing though is that a lot of borrowers are choosing to really take their time and structure their loan terms to meet their individual needs. They're not just taking a blanket loan program. So some folks are saying, look, I really don't want to bring in a bunch of cash to closing. I'm willing to take a little bit higher rate if it means I don't have to deplete my savings or my investment accounts. That's great. If they don't plan on being in the home for very long, could be a good option. On the other end of that spectrum, I am seeing folks that are saying, we'd like to bring some cash into closing, buy down our mortgage rate so that we have a much lower payment. And over the long run, that's going to save us money because we do plan on being in this home or having that loan for the long term. So make sure you sit down with somebody that understands loan programs. They can advise you correctly and help educate you on what might be the best choice for your personal needs. Moving on, the National Affordability Index is not great right now. However, it has improved a little bit. Basically, the US has a housing shortage of about 4.5 million units. Now that's a nationwide number. There are some folks that'll say absolutely not. That's inaccurate. You know, there's so many homes that are sitting vacant, so those could be used as housing, but they're not. I don't think there's as many of those as some of these, we'll say, bear market aficionados really believe. Yes, there are vacant homes. Some rentals are sitting vacant. I'd be curious to really dig more into that data, find out where they're getting that, and see if there really are that many vacant homes sitting that could be used for active housing inventory, whether that's put them up for sale, buyers can purchase, or put them up for rent so that tenants have somewhere to move. But according to the report from the U.S. Chamber of Commerce from March of this year, there are 4.5 million units that we are short of housing. Obviously, those market dynamics vary from city to city. Some have more, some have less. But overall, I'd say the two major contributing factors to that are the cost of materials and labor and some of the restrictive building regulations around the country. Good news, we do have environmental controls. Bad news, sometimes that does make it a little bit more cost prohibitive and restrictive to do large scale development projects. So make your own decision on that. According to a recent Realtor.com article, during the last 3 months, for every 100 new listings, 13 homes got delisted. And according to this article, they waited 30 days to make sure those weren't just pulled off the market and actually put right back on. Now, obviously, someone could wait 31 days and put their home back on the market. That would be considered a new listing. But for their data, they did say that highest over the last 3 years, that 13 out of every 100 homes were pulled off the market. So that's a really big shift in our market. That is due to just on average, higher volume of properties on the market. Obviously, if there's more available, more are going to get pulled off when they don't sell. But that is also an indicator that the housing market is not moving the way that it has been up until the last few years. The interesting thing about that is the article referred to unintentional landlords. And I think that indicated, yes, some people put their homes on the market, they move out, they expect it's going to sell, they market the home as vacant, and then when they don't get the price that they want, they could sell it. They could drop the price, they could sell it. But when they don't get the price that they want, they choose to pull that home off the market, and instead of leaving it vacant or moving back into it, they are choosing to put it up for rent. So the good news potentially with all of this, supply and demand, right, is that with an increased supply of rental homes, it could potentially create more competition and bring rental rates down for tenants and for those that are looking for rental homes versus apartments or condos. So could be a silver lining. There's some good news to that. In the current housing climate, many sellers do have fixed low rates and they do have a large amount of equity. So this allows them to choose when and if they want to sell their home at current market values. Overall, that is part of the reason that we are not seeing large value drops in the housing market. I should say, everyone, there's a lot of folks that keep saying, oh, we're due for a crash. We're due for a crash. We're gonna crash. I don't think we are. And that's part of the reason why. And in fact, I expect, and we'll see how the numbers come out next month, I expect we're going to see a big pullback in the amount of inventory as a lot of homes just get pulled off the market and sellers say, look, I don't have to sell, so I'm not going to sell. It's not like 2008 where we had a lot of distressed owners. Anyway, this realtor.com article that I mentioned also pointed out that Phoenix had the highest number of properties being delisted. So 30 out of every 100 homes were being pulled off the market. So that's a really, really big shift. Additionally, 20.6% of homes had a price reduction in June, which is up by 2.2% over 1 year ago. So we are seeing more price reductions, more homes being pulled off the market. Talked a little bit about how that can impact rental rates. I think it's going to hold the market stable. So until we have enough sellers that decide I have to sell and they start dropping their prices and competing against each other to get their homes sold, we're really not going to see home values drop the way that we did in 2008 to 2010. Could see a little softening. We've seen that since 2022, but it's not going to be to that degree, in my opinion. So let's dive into the local market data and we'll explain that a little bit more. So for the Tri-County area, we saw that active listings are up 6.9% from May to June. Pendants increased 2.1%. Good activity there, lots to choose from. Buyers are getting into contract. However, the number of solds dropped by 10.8%. Remember, the solds are lagging by 21 to 30 days. So that is a sales number basically from May. Now we're looking, next month, this month in July, once we get all the data, we'll be able to look at the numbers from June. This indicates, there is a higher level of inventory, but fewer sales than last year. So a lot of buyers are pulling out, a lot of contracts are getting canceled. This is further evidence of a softening or a softer real estate market in the greater Sacramento region. List price to sales price ratio actually dropped from 98 to 97%. So homes are selling at 97% of their initial list price. In addition, we also have to look at, okay, that's fine, but are sellers listing at a higher average rate than they were? Are they overshooting the market? And the answer to that is no. The average listing price did come down. So sellers are being much more reasonable about their pricing. The market is just not as strong as it was. Days on market increased from 33 to 36 days. That's not a huge change, but it is a trend in that softening, slowing market direction. The median sold price in the Tri-County area actually increased from $600,000 to $610,000. However, $610,000 is the same median sold price that it was in June of 2024. So we've seen a little bit of fluctuation month over month, but overall the long-term trend, again, the market is flat. The big thing, inventory hit its highest level for at least the last 8 years. I didn't go back farther than that, but we did hit 3 months worth of inventory based on closed sales. Based on our Sacramento market dynamics, 3 months worth of inventory is where we really start getting into a solidly balanced market. That's not a seller's market, not a buyer's market. But if we start seeing much more inventory on the market, we could be moving quickly toward a really clear buyer's market where buyers have the upper hand, not sellers. As I said earlier, I do expect we're going to see an inventory pullback as we move through summer. A lot of those sellers that I mentioned that are testing the market to see if they can get a certain price. Once they realize they can't, they're going to pull that home off the market and do something else with it. This is usually when we see the peak of our inventory, usually during late June into July, early August, and after that it starts to decline again heading into the holidays. So obviously hitting a new high for market inventory is something to take note of, but I do want to watch the trends over the years and kind of get an idea of where the market's moving. So we'll come back to that. Let's dig into Placer County specifically. Active inventory is hitting the highest point in the last 5 years. So it's up 6.7% from May to June. Pendeds are up 9.3%. And again, similar to the Tri-County area, solds actually dropped, but they dropped by a lot more. So we saw a lot less sales and it dropped by 15.7%. So again, buyers are canceling, fewer sales coming together. We are seeing a lot of cancellations. There's a very wide gap between what a buyer will pay and what a seller will take. A lot of buyers and sellers are just not putting sales together. So in June, did see the lowest sales rate for the last 5 years, and that was only 387 sales in Placer County. That is very interesting to me. Not a lot of market movement or market activity there. Days on market, we saw a slight increase in Placer County from 37 to 39. Not a huge jump, but again, it's a trend. And homes are selling at only 97% of list price. So that is down 1% from May to June. On a positive note though, in Placer County, the median sold price jumped 6% from 665 to 705. So pretty big jump there. And the good news, well, good news if you're a home owner, that is the highest median sold price in the last 3 years since home values in Placer County peaked in June of 2022. So they peaked at $719,000 for the median sold price. And now for June, they're up to 705. So getting much closer to that. Placer County saw an increase of 2.6 to 3.3 months worth of inventory. So that's a pretty big jump. Again, like I said, anything above 3 months, we are solidly in balanced market territory. Not a buyer's market, not a seller's market. But again, the higher that goes, it gets closer and closer to a buyer's market. So that is also for Placer County. That's the highest level of inventory since pre-pandemic. We have not seen these inventory levels in quite a while. All that being said, the market is still showing us 2 different sub-markets right now. And I know I've mentioned this before, about 2/3 of homes are really, I would say, in a buyer's market right now. They are seeing price reductions. Those sellers are giving up credits. They're agreeing to lower prices. They're giving up on the terms. Buyers are really winning on those properties. The other third of the market is, I would say, still a seller's market. Those sellers are getting full price, sometimes a little more, sometimes a little less, but those homes are selling quickly. They're selling in, 2 weeks or less. They're getting a lot of attention, sometimes multiple offers. And that third of the market is still seller market territory. So that's something to watch and see how things shift. So overall, in summary, I'd say overall, our fundamentals are still fairly stable in the Sacramento region. Again, that limited inventory, limited housing is keeping prices and home values stable. Unlike other areas, I would say let's just see where things go for the next 12 months. We've got a lot of other financial market pressures. A lot of things are in flux right now. AI has been the huge buzzword in a lot of different categories and in a lot of different sectors. In my opinion, that's going to be a big disruptor for the next 10 years in a lot of areas. And I don't know, I love reading news articles and news stories that come out about AI and what they've done. And there was one about a robot that just did a very complex surgery with 100% accuracy. It did have some input and was able to respond to prompts, from developers and doctors, engineers in the room. This was not a human surgery, but that just puts us one step closer to some really, really exciting potential in the AI space and in the machine space. So obviously we don't want to go the Terminator route, but there's some really great potential there. So thanks again. Have a great month. And I look forward to coming back with some fun news stories and some good data and hopefully some positive things for the real estate market next month. And we'll talk to you then.